All right, so after a pretty significant down day on Friday, pretty much correcting the moves that we had on Thursday, which was not what would expect and probably shouldn't have had. And as you saw, the market corrected it pretty quickly on Friday and then some, right? So pretty down day on Friday. It would have been really nice to kind of get a buy the dip trade today, considering that's what the markets have done for most of this bullish trend we've been on here since October 22. Wasn't the case today. We didn't get very much of a move at all. It was a very quiet day. There were some moves. It was kind of interesting. There's an intermarket relationship that we haven't seen in a while that kind of returned back here today. So we'll talk about what that relationship was and what it means for our expectations going forward. We'll take a look at the different sector moves. A pretty surprising leader in the clubhouse today from a sector rotation standpoint. We'll talk about whether its peers also did well and whether that bodes well for the markets going forward. And then we'll take a look at our trade idea. Coincidentally, in the market leader for today, the sector, we'll take a look at a pattern that's developing on its chart and talk about how to trade it going into October expiration. So let's go ahead and get started. Today is Monday, September the 18th, 2023. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel with this icon here or the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our website, check out some of these other things over on the right, including our Market Outlook live video. You can also catch Friday's Market Outlook by clicking on the 15th, the September 15th video. Come down to the bottom, click this heart. It opens up this tab. Hit that like button there. Same thing here. Click the thumbs up icon. It opens up this tab. Hit that like button. Again, it really helps us out a lot by getting our content out to all of our followers on those platforms. The more people like and share and comment, that's why we always ask. So our goal is to get to 100, as it is every day with these Market Outlook videos. So thank you to those who like these day in and day out, and those who don't, you can do right now while you're watching with one or two really easy clicks. All right, let's take a look at the S&P 500 with the market forecast indicator here. As you can see, we finished slightly higher, so that would be the 11th Monday in a row now that we've rallied to the upside. This would be one of the smallest up days. In fact, I believe September 31st was the last time we had this small of a Monday rally. Every other Monday has been pretty good, but every Tuesday, except for one, that Tuesday, August 29th, we were down. This Tuesday was the anomaly where not only were we up, but we were up a lot. But every other Tuesday following an up Monday, we end up coming lower. And that was the case. That was the case the last time we were only up this much. The other Mondays, if you take a look at the other Mondays here, so here's today, so barely up at all. September the 11th is right there, so we were up more than 0.5%. September 4th, we didn't have one. It was August 28th because it was Labor Day. Up more than 0.5% again on August 28th, August 21st. Up more than 0.5% again, August 14th. More than 0.5% again, August 7th. Almost 1% gain. And then, of course, July 31st, we were barely up at all. Going back to the, further, the 24th, it was a small, 24th is almost 0.5% of a gain. The 17th was more than 0.5%. Excuse me, 17th, just barely below 0.5%. The 10th was just barely below 0.5%, right there. And then the 3rd, before the July 4th, was also. So July was pretty weak, but they were all up. And then August has been really strong going into September. So very good returns until today. This is the weakest out of all of these. I mean, even July 3rd, it was a weak one. We were up 11 hundredths of a basis point. Today we're only up 6 hundredths of a basis point. So by far the weakest gain, especially coming off of the biggest loss that we've had. I mean, yes, Friday's at 1.5%. That was the biggest loss that we had since this 1.5% decline on April 25th. So nearly 5 months, the biggest loss of the past 5 months. And that one we followed up with a small loss and then a really big 2% gain. We'll see if that follows through here tomorrow, whether we follow through. And again, considering the Tuesday pattern being down, it probably won't. So we'll see how that ends up playing out. Of course, the near-term line, the momentum line had dropped to extreme lows yesterday. The near-term line followed into the reversal zone today. So pretty bearish short-term pattern here. The intermediate line did turn back down. So it is, and we are slightly below the moving average still. So it's still red. We have light pink shading in a red line now. We're not back below the 50th percentile yet. That's when the shading turns dark pink. So we have the intermediate line is still below market sentiment. So, again, they're both between the reversal zones. So it really matters whether you're above or below that. And as of right now, we can't get above it mainly because the near-term line can't get above the intermediate line and stay above it. It can't get into the reversal zone itself. And the one time it did, it tried to get the intermediate line up. That was the best move. And then again, since then, we haven't been able to. The near-term moves have not been very strongly bullish, and we've been progressively, getting lower near-term high points here. You can see that as well in some of the other indexes like the NASDAQ. Same thing, the intermediate line is peaking in the lower end of bullish territory, not getting into the upper reversal zone. Sporadic days of dark green shading and a green line with the bear tag and not following through. Of course, we got the bear tag on the Dow last Thursday and continued lower here. The intermediate line's well below market sentiment and the near-term line's back down into the reversal zone. And then for the Russell 2000, another cluster today. So this is the second cluster in the past week, past 5 days or so. And you can see the momentum line down to extreme lows again, as we were down nearly 0.7 of a basis point. The near-term line also down into the reversal zone after a really bearish peak there, very much a lower high point, and of course closing below. I see this low point was 1831, so we're barely above that low point. So we're really close to closing below the lows of all these moves, and again, really turning bearish here. Again, it's very similar because nothing else is really that strongly bearish, so it's very similar to what we saw. And I have to go back now 3 years. It's interesting. 3 years here too. Back here in November, where we turned pretty bearish here in November and December, by mid-December, and then the beginning of the year was just a failed bear tag before we fell down and really broke down there. And this is where the S&P, notice during this time frame. In December, the S&P rallied. We had a little pullback, but we rallied. And then by the beginning of the year, where the Russell was getting a bear tag that failed, the S&P was forming a higher high. So just like then, where the Russell was more bearish than the S&P 500, it appears to be the case, with a cluster no less, that appears to be the case again, where the Russell is kind of leading the way lower for the broader market, kind of giving us an indication of what we should expect from the other equity asset classes. You are still above the 10-week moving average, so no red arrow yet. It is a slightly bearish candle as it's trying to figure out which way it wants to go. Not the case for the Russell. We're easily below the 200-week moving average now, getting a lower close. We got the red arrow 2 weeks ago. The PPO is falling, close to crossing below zero. The Dow Jones Industrial Average, we're getting all these transition candles, can't really get going really one direction or the other yet. Taking a look at the 3 green arrows for all the 4 major indexes, we have 3 red arrows still on the S&P, so 2 days in a row. Of course, we've been 3 red arrows for a while on the Russell. The diamonds did not get 3 red arrows yet. We've had the 1 day of 3 green arrows that failed, just like it did on the Russell. And you can see the Q's even got 1 day of 3 green arrows too that appeared to have failed. And we're back to 2 reds on Friday, and still at 2 reds, and really close to 3 reds on the NASDAQ 100. Looking at the S&P here with the moving averages, you can see again the clear breakdown on Friday below all these moving averages after being way up above them all, going from way up above them all to pretty significantly below them all. Big significant change. The MACD is below its moving average and falling. It's negative now. The stochastics is out of bullish territory into the lower half of the chart. So things have definitely changed from that perspective. So the 8 days crossed below the 17 just barely. That's why the blue line's at a negative level. Of course, IWM, remember there's a big gap there in the S&P between the 50 and 200-day moving averages. The IWM's already below its 200. In fact, it's more below its 200-day moving average than it has been since the banking crisis we had in March when it really broke down. And you can see the MACD is below zero pretty easy. The stochastics is actually in its lower reversal zone. So you can just see how clearly bearish the Russell is. Looking at the S&P here, you can see we are above 25 on the negative indicator, even if we're still above 20 on the positive. So not quite bearish pattern there. IWM is showing a bearish pattern still. Of course, still above 25, below 20. ADX is slowly rising above 20, so we are in bearish levels there. The RSI and the CCI we talked about on Friday, watching this, it's barely below the midpoint of the chart. This one's not. This one is working its way back below minus 100. But the key one is to watch this one. The weekly CCI is back below zero now. And the question is, when it gets below 100, that usually sparks the beginning stages of a correction. So that's really important to watch. Of course, that won't happen unless the daily indicator gets below 20. Of course, and then stays down there. We'll see if the RSI follows through with this break into the lower half of the chart by falling below 40, and that of course hasn't happened yet. The Ichimoku cloud, we are marching towards that pink area there. We're still kind of sitting right there with a negative rate of change, and then again, we don't have a trend right now. We don't even have a weak bearish trend anymore. We kind of had one a little bit on Friday, but they're both hitting zero today. So really no trend at all going on the S&P. There is a weak trend now on the Russell below -1 above 50. So we are well below the cloud, and we are approaching the pink area that's widening. So and the rate of change is full on bearish. So this is, it's still a weak trend, but we are full on bearish patterns all across the board here on the Russell 2000. Looking at the Bollinger Bands for the S&P, we are in the lower half still, but not in the lowest quartile. So in fact, the bands are really close to crossing back inside the Keltner channels and giving us red dots. So important to watch to see if that red dots is a transition from positive momentum to negative. And this is the weakest positive momentum that we've had this year, this past 12 months. We'll see if that turns into something that already is showing up on the Russell. The Russell never did get positive momentum, and when it had the red dots, and it's now we're flipping back into the lowest quartile of the bandwidth. The bandwidth is low, starting to turn up. So you expect that you'll get green dots here soon, but instead of with positive momentum, most likely with negative momentum again, as we are, like I said, in the lowest quartile there of the chart. Looking at the intraday chart here, you can see again we're sitting really right on this very, very important level. Lower high, slightly lower low. We closed above yesterday's and last week's low, but very important. You can see just how important it is. You break down below this, and there's not a whole lot of layers down there. The low point is going to move up to there. That's why you see the Arun, the negative indicator jumped up. But again, you got that one touch, and we're below 50 now on the positive indicator, which means now the high points in the first half of this chart instead of the second half, the first 2 weeks instead of the last 2 weeks. So we are like still not bullish at all. And again, a break below these levels anytime this week, sooner rather than later, in my opinion. And we are going to be headed down towards. We're going to get the break to a new 4-week low point, and we'll get this line to break up to 100 is what I'm expecting to have happen. As it does appear, we are in that mode right now of intermediate decline with the 3 red arrows in the market forecast. It was a small range today, half the average, very small volume, coming off of a day that was very big with that expiration. It's a very quiet Monday It didn't have that big of an impact on volatility either. Volatility ended up a little bit, but not very much. Kind of pretty much right around the same level as it was at the end of the day on Friday before a small little pullback. The VVIX didn't jump up either. So about as quiet of a day from a technical perspective as you could possibly have. Which when you look at, from considering how big of a day we were on Friday, it would have been nice to kind of rebound, right? Buy the dip, right? If we would have got the buy the dip scenario. We didn't quite get that today. And we'll see if we get that tomorrow, Wednesday, but I'm assuming, my expectation is we won't, that we'll end up more bearish here this week as we start to build into this pullback here. Taking a look at how things moved here today, again, very quiet day going into September 18th here. Again, you can see the moves. The gold and bonds are your best performers today. Real estate, the dollar are both down, so not quite the patterns that you normally see where commodities rally, the yields rally, and the dollar rallies. In fact, it was kind of the other way around. The dollar was down, yields were way down, and commodities were slightly lower. They started the day up, but were slightly lower. Here, let's just switch to like a 5-minute chart so we can see this a little bit better. Started the day higher, commodities did, but then came lower. So, I mean, this was a day that you would think, okay, bonds were up a lot, which means yields are down. The dollar was down, so the stocks should have really rallied. And stocks did outperform, like real estate, and but not, didn't outperform bonds and didn't outperform gold. This is more the traditional safety trade, where gold and bonds are the big winner. Bonds move up with risk aversion instead of moving down with risk aversion, which has been the case for so long. You can see it's sold near 52-week lows. From a long-term perspective, especially, you're so far down here, well below these moving averages. But not with the biggest momentum. The biggest momentum occurred here. The washout phase occurred at the end of 2022 in October, and we're retesting that, but with far less momentum this go around, which means either we'll get some kind of double bottom trade or even maybe a divergent low point. But my expectation is the next time this rallies, it will most likely rally because of risk aversion, not risk appetite, right? Before it rallied because, here in the latter part of last year, first part of this year, it rallied on risk appetite, right? People are willing to buy long-term bonds as a risk trade. But it failed to get above the 23% retracement and stayed down in this area. And now I think the next time it will do that, it will most likely occur with a risk aversion trade. And when you look at like the ratio chart here of the Qs relative to IWM, we've talked about this before, that more than likely that means that this chart will start to move lower too, as typically the Qs underperform in a risk aversion trade. You can see, again, it was a quiet day today, but we are still below the moving average on the number of stocks below their 50-day or above their 50-day moving average. 150 is a key level for correction territory, so something to watch there. The new highs and new lows index is still pretty bearish, back below its moving average to a pretty significant negative number, which typically at least coincides with pullbacks. So we are definitely in a pullback stage, and we have been since the beginning of August. But you can see clearly that we're not getting a very good breadth at all. When you look at the McClellan oscillator here, you see we're not very strongly negative, but not positive either, and the summation index is still below zero. So we're not getting very good breadth, and the money flow is still relatively poor, right? We are slightly into the lower half, but again, we're peaking here after being slightly above the lower half. We're peaking at a much lower peak than what we've seen on some of these other stronger bullish levels. So we're not getting very much breadth. We're not getting very much money flow at all. The whole moving average has turned bearish with the parabolic SARs above that, and the candles turning bearish again. That's on the daily. Of course, the weekly had turned bearish, and then we were kind of positive, but not positive enough to change the whole, not positive enough to get the PPO above its moving average, and not positive enough to turn the parabolic SARs around. So we're kind of back in, looking like we're getting back in the bearish mode. Small candles. We still haven't got very big candles here. And we'll see, you know, this again, the size of the candle is more appropriate where my cursor is for pullbacks. And of course, it gets bigger whenever you start looking at corrections, as you saw over here in some of these other levels. Like here's a correction mode. If you follow my cursor all the way to the right, you can kind of see again what we expect to see on the size of these candles once we do get into a correction. Let's take a look at how the sectors performed today. Again, you know, like I said, commodities have been doing very well, and that's really helped out the energy sector over the last little bit. Energy sector actually held up again today. Technology, of course, was your big winner. Discretionary, on the other hand, underperforming staples. You can see that is a risk aversion ratio there. Utilities underperforming financials. That is a risk appetite ratio when financials outperform utilities by that much. Two separate sides of an interest rate sensitivity coin. And of course, you can see technology and other safety trades, you know, not doing as well either. And when, you know, you got like industrials and materials and technology, when technology is outperforming those areas, they're more economically sensitive, then the market's more focused on growth, especially when the communication service is up there too. So, you know, it's slightly positive day, but, you know, again, very slightly positive, not positive enough to even come close to reversing what we saw on Friday. As you see on Friday here, you know, again, XLY, you know, XLK was down quite a bit. It's still one of the bigger losers of the 2 days. And then if I were to go all the way out to August the 1st, when this whole thing started, right, the whole pullback started here. Again, you can see XLK is down here at the bottom. Discretionary had been outperforming. It's pulling back. Staples, real estate, materials, industrials. Again, materials and industrials are economic growth sensitive areas. Despite the fact that we have really strong estimates for third quarter GDP, those areas are still lagging pretty significantly behind, along with technology, no less. So again, you can see how we're not really that risk, you know, like there's not a whole lot of risk appetite here, even with utilities and staples lagging behind, which you would expect those two to be bullish during a pullback, and they just weren't. Healthcare was okay, but energy's been your safety trade right now. In fact, it's the only thing that's actually, you know, really significantly outperforming the market. Healthcare was, but it lost that outperformance. And then communication services and discretionary financials kind of are to a small degree as well. So not quite the typical pullback as you would normally see from the sector rotation. You can see when you look at all the sectors, all 11 sectors together, you know, you've got staples and real estate in dark pink shading and a red line, along with healthcare, industrials and materials, dark pink shading and a red line, along with technology. But energy is looking great. Financial is not looking that bad, along with discretionary or communication services. So we're not. That's why the market itself is not quite in bearish mode yet, like you have pretty much with 1, 2, 3, 4, 5, 6 of the 11 sectors all in bearish levels. And not just from a U.S. standpoint. When you look at the 12 grid for all the major ETFs out there, tracking the major economies, Japan's looking great, and India's looking great. And you know, some of these others, Korea's not looking as bad, but Germany and France, two of the largest economies in Europe, struggling right now, and you know, some of these others not struggling so badly, with the, like I said, light green shading, with the intermediate lines rising at low levels, in particular in Italy and Korea and China, the UK, Canada, Brazil, all looking pretty decent with dark green shading and the green line. So we kind of got a mixed picture here too. We're not quite risk off yet, but definitely not quite like broadly risk on either. That takes us to our trade idea of the day, and I want to take a look at Twilio. Twilio looks very similar chart to a lot of these other tech companies. It was actually down quite a bit today, breaking below its moving average. The intermediate lines rolling over pretty sharply with very bearish short-term sentiment. Now we're down 2% below the moving average, so pretty significant turnaround for Twilio. You can see its weekly chart. It's been in a death cross environment for quite a while. You got the red arrow after a transition candle last week with the red arrow. We're getting a bearish candle this week back below the 10-week moving average. On the Hakinyashi close, From a 3 green arrow standpoint, as I mentioned, we were below the 30-day moving average today. Yesterday or Friday, we closed below the 17 and the 50 and the point of control, and then today following through with some bearish, since you can see the MACD and stochastics pretty clearly bearish there. A lot of these other oscillators showing bearish patterns as well, a bearish crossover on the DMI, bearish levels here on the RSI and the CCI, dropping easily into lower half of the charts. We are below the cloud while as it's at peak area, so very important to be above that cloud there when it turns peak. We're below it. We never did turn green on the cloud itself, plotted 26 days out. Whatever small little weak bullish pattern we had is gone, and we got flirting with a negative rate of change and below the blue line on the Ichimoku. So pretty, developing bearish pattern with a drop into the lower half, flirting with the lowest quartile of the bandwidth. And like I said, below the point of control, not a whole lot of volume here down until we get down to these lows around 45. And the bands outside of the bands have been outside of the Keltner channels because of this rally, but of course that rally now done, and you can see the bands are moving back towards the Keltner channel, and the momentum is swung, but definitely not bullish anymore. So I don't want to be too aggressive in a bearish trade, but we definitely can be somewhat aggressive here. Sell the 56, as you notice here. Twilio has about a $54 target based off of 1 standard deviation of volatility going into October expiration. So if you go a little bit above that at 56, sell that one, buy the 58. Position size for normal risk. You can see how much flexibility I have, about a little bit more than a 2-to-1 reward to risk ratio, and I have some flexibility if it doesn't work out. So usually if that max gain gets outside of this 1 standard deviation window, then we start to look at potentially closing the trade. But in this case, even if it does rally for a little bit here and retest that point of control, we have some time for it to do that before having to really make a move to get to the reward that we want to get to by October expiration, because it has to get there and then it has to stay there by the time the contracts themselves expire. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Follow us on join us at marketscholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your weekend, everybody, Monday night, everybody, and we'll see you all next time.